Hi, good evening. Today we will cover a stock called Dixon Technologies Limited. Very interesting stock. Again, the stock analysis was requested by one of the viewers of the channel. Now, Dixon itself is a very big beneficiary of the entire Make in India push by the government. Today, it manufactures about 35% of the LED TVs of the country. It is the largest manufacturer of LED lights in the country. It is also one of the larger players engaged in the manufacturing of both smartphones and feature phones. It also is present into the white goods segment, and it manufactures refrigerators as well as washing machines. In terms of growth, it has grown its sales at a fantastic 32% CAGR over the last 10 years, with the trailing 12-month sale coming at close to 21,000 crore. Now that's a sizable business. It is again debt free, and it has got a fantastic ROC of over 25%. Even with the positives mentioned below, is it a business worth investing in today from your point of view, the investor's point of view? That is what we are going to explore in this video. Without much further ado, let's get into it. Let's take a quick financial snapshot. As mentioned earlier, trailing 12-month revenue is 21,000 crore with a 10-year average CAGR of 32% growth in sales. Its debt is 490 crores, which is comfortable considering the kind of revenues and the profits it makes. Its ROC is a healthy 29%, and its ROE is a healthy 24%. Now, what bothers me here, if you look at it, is the very, very thin operating profit margins at 3.87%, and consequently, very, very limited PAT numbers. So, essentially, even when it's making such a fantastic top line number of 21,000 crore, the PAT number is only 2%. Now, let's discuss what's good about this business, what's bad about this business. What's good about this business, obviously, is the government PLI push and hence a visible path to growth, at least for the next couple of years. What's also good about Dixon is that it is already diversifying across product lines. It is already trying to diversify in across geographies, and it has started export markets. It has got a fantastic client base with who's who in the electronic segment as its clients, whether it's lighting, whether it is mobile phones, whether it is LED TVs, and so on and so forth. It also is expected to benefit from the China plus one strategy of most of the multinationals. Very limited debt is also a plus, so is good ROC and ROE. Now, what are the risks or what are the issues which the company face? The first and the biggest issue which I see with this business is very, very low operating profit margin. As can be seen from the numbers, the operating profit margin for last year was only an abysmal 3.7%. Now, that means that, what does it mean? Low operating profit means it is susceptible to sudden increases in costs or sudden loss of revenues. Also, it is susceptible to sudden disruption in production leading to losses. What's also of concern to me is that even though the debt on the balance sheet is only less than 500 crores, there is a sizable non-fund limit of 1700 crores which the company enjoys. Now, most of it is related to working capital, which is LCs and BGs, but still, these limits are a huge limit, and in case anything happens to these, the company may not have the liquidity needed to address, disruptions in the limits. The company has literally no intellectual property in its name. It is just an assembler of white goods. It does have limited IP in the lighting space, wherein it has designed certain tube lights and certain LED batons and so on and so forth. But really, that IP is not that much valuable. The scope of improving margins in such a business wherein I'm a contract manufacturer is very, very limited. Most of the buyers you have today will constantly ask you to reduce your prices, to improve your efficiencies and pass on the costs to them. Similarly, from whatever I have seen of businesses, such businesses, it's very difficult to improve gross margins. Even economies of scale in such kind of businesses do not have a positive impact on the gross margins. We can see this from Dixon financials also. Even though the turnover has grown to a sizable 21,000 crore from little less than 7,000 crore a couple of years back, the margins still remain in the similar range. They have not really improved the margin, operating margin percentages. So even economies of scale cannot help it. There is always a downward pressure of on margins from the customer side, and also the margins are susceptible to changes in product costs and the environment and kind of any kind of accidents and losses. This is the biggest issue which I see with Dixon's business. Now comes the million-dollar question: what do I think of the business? I personally think that yes, it's a good business, stable business. The demand will remain, but at the same time, with such a low operating profit margins, it's not really a business worth staying in. At 3% and 4% margins, you're not really doing anything much. In fact, trading businesses have such margins, and here you have an entire manufacturing and assembly setup to achieve those margins. So I personally will say that as a business, simply these low margins make it very, very unattractive for me. The next question is, what can Dixon do to improve its business? What are my thoughts around it? Couple of thoughts. First, it needs to get into adjacencies which have better margins. That means launching its own lighting brand, so be it. That means launching its own white goods television brand, so be it. As we can see from the other listed competitors, whether it's BPL or whether it is Samsung Global Operations, the margins in those segments where you're reaching out and selling directly to consumer is much, much better. So one, Dixon has to immediately get into and selling to the consumer directly, building its own brand and improving its margins. The second option which the company has to improve its margins is to go into further backward integration. It is already getting into plastic molding and air conditioner manufacturing, which have better margins and which will have an incremental impact on margins. But will it really move the needle on a 21,000 crore top line? Not more than maybe 25 basis points or 50 basis points on the outside. What it really needs to get into is the technology part, whether it is actual manufacturing of LED bulbs or manufacturing of printed circuit boards and the related electronics. That is where drivers, that is where it needs to get into to get its margin better. That is my thought around it. It either has to get into building its own brands or it has to get into so much backward integration that it makes all the key components and does not import it. So that is as far as the good of the business, the bad of the business, whether I like it or not, and how I feel it can grow. Before we get into whether I feel this is an investable company today or not, I also want to bring out one more point to you. On the screen here is the detailed shareholding pattern of the company over the last 10-12 quarters. From a September 21 shareholding, wherein the promoters held a 34.93% stake. Today, in June 2024, the promoters have only a 33.24% stake. Yes, it's a slow and gradual reduction in stake. But yes, if you see almost every quarter, promoters have diluted some stake every single time. The question is, why are the promoters doing this? I am not very comfortable personally when promoters keep diluting their stake, even in very, very small numbers. Not really a very good indicator of promoter confidence in the business. The slightly positive part which I can take is the most of the stake is bought by FIIs and DIIs, which have constantly improved in the same period. But overall, promoters selling their stakes is not really a good thing. Now we come to the million-dollar question: whether how's the valuation today? Is it worth investing today? Now again, before I get into this, this is not a stock recommendation. This is, you're not supposed to be influenced by it. You're supposed to do your own research before investing. This is just my opinion on the stock and its valuation. If you recall, the company is growing at 32% CAGR. So what I assumed is that the company will keep growing at a similar CAGR, in fact, a better 35% CAGR over the next foreseeable future, next maybe 5-7 years. The PAT percentage was at 2.1% last year. Now I'm assuming that it will improve by 15 percentage points every year. Now, those two are the assumptions which I have done. Basis that, the revenue will grow from 21,000 crore trailing 12-month revenue to about 79,000 crore in 2029 and to about 1 lakh crore in 2030. Now, this growth of 35% itself will be Herculean task, will be a very tough thing to achieve, simply because it is now starting on such a large base. As your businesses get larger and larger, the revenue growth slows down. But let's still assume that it will keep growing at 35% and it will reach that 1 lakh crore turnover in 2030 and 80,000 crore turnover in 2029. At an improved margin of 3.7%, the expected PAT for 2029 is 2,900 crore. I'm again repeating, assuming that the company will keep growing for the next 5 years at a 35% CAGR, and assuming that it will keep improving its PAT by 15% every single year, it will reach a PAT of 2,900 crores by 2029. Now, the market cap of the company today is already 90,000 crore, which on a PAT of 2,900 crore gives me a multiple of roughly 31 times on its 2029 expected PAT. A business which is growing at, which is an operating margin of 4% and a PAT of 2%. Yes, it is growing fast, but the profitability is, in terms of absolute numbers, is very, very minimal. I will not personally give it a multiple of 200 times at any point of time. Where I'm comfortable is maybe a multiple of its growth, which is 30-35 times and nothing more. So if I consider that as my comfort zone, the market is giving it a different story. You may decide it's a different multiple. What I can make out from this is that the market cap today already discounts the growth, at least for the next 5 years. If I invest a certain amount of money in the stock today, I can expect no growth in my investment for the next 5 years at least. Is it a good business? Yes, looks like a good business, essential business. Is it worth investing today? Considering that the next 5 years growth is already factored in the prices today, without even considering any discounting factor as such, it is a miss for me today. So I'll see you next time with another analysis. Do like and subscribe. Happy investing to you.